Enable.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome to the Mutual Fund Day Family Financial Plan series, where we get you a ringside view of many journeys of financial planning from across India. The idea here is to help you learn from the experience of our featured investors so that you can navigate the world of personal finance with a better sense of direction. We also have on board a financial guide to help you figure out the shortest route possible to achieving your financial goals. So, let's start our trip with introductions. Our featured investor today is from New Delhi. His name is Mr. Rajesh Sondhi. And to provide us with insights on money management, we are joined by his financial planner, Mr. Ravi Kohli. Now, before we go any further, let's take a brief look at the investment journey of Rajesh so far.
In today's episode of Mutual Fund Day Family Financial Planning series, we will be looking at the financial planning journey of Rajesh Sondhi from Delhi. A merchant trader by profession, Rajesh lives with his wife Pooja and their 2 kids in Delhi. He began his investment journey in 1988 after his father introduced him to their financial advisor, Ravi Kohli, and has been very diligent with his investments ever since.
My investment journey started very early in my age. I was only 23 when I started investing. Thanks to my dad. I was making about 5,000 rupees a month. I started investing since then, and I've always made sure that part of my income, part of my monthly income goes into mutual funds. And then slowly I went into stocks, but more of the investments have been in the field of mutual funds and real estate. I did have some ups and downs. Certain IPOs, they failed to perform, or certain real estate investments did not give the right kind of return. But mostly it has been a smooth sailing, and mutual funds systematic investment has been very beneficiary for us and for the family.
Apart from Rajesh's merchant trade venture, the family also owns an e-commerce business which is handled by his wife Pooja. Their eldest son Akash is presently in the US completing his graduation, while Aryaman stays with his parents and is studying in grade 11.
We could plan our life wisely, sending our one child overseas in the US for studies, which is again demanding a lot of investment. And thanks to those investments which were made earlier, has given us results now.
With almost 2 decades of investments and timely guidance from their financial advisor, Rajesh is very patient and clear when it comes to his goals and how to go about achieving them.
My eldest son will be graduating from a university in USA this year, and for the younger one, we've also had SIPs in his name, and I'm sure by the time he reaches his university, he will have sufficient funds to take care of his education and other expenses. Other short-term expenses are, when you look at, is like about the renovation of the house, basically looking after your medical expenses, traveling, gifts. When we talk about the long-term goals at home, we basically talk about asset creation, building assets for our generation next. In case they decide to become entrepreneurs, they need working capital requirements, or they want to become businessmen, so I can support them. There are ups and downs in business, but once you have secured cash reserves with you, the confidence in you increases and your approach to the life changes.
All right, now that we've had a good look at the rearview mirror of Rajesh's investment journey, it's time to take a short break. When we return, a detailed analysis of Rajesh's finances with our money guide, Ravi Kohli. Stay tuned to CNBC TV18.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Welcome back. If you're just tuning in, this is the Mutual Fund Day Family Financial Plan series where we help you understand the nuts and bolts of financial planning using the experiences of those featured on this show. We are back with Rajesh Sondhi. After a brief look at his financial planning story, we will pick up the pace now to learn more about his investments, his goals and asset allocations, with insights on money management being provided by his financial planner, Mr. Ravi Kohli. Gentlemen, thank you so much for joining us. Rajesh, let's start with you. Give us a brief outline about your portfolio, where it's invested, what sort of assets have you looked at?
See, my investment portfolio, I started building it in 1989. Started with mutual funds, LICs, then slowly into real estate. The market was good that time. And at present, I can say, with the real estate prices going up, my portfolio today is like about 60% is invested in real estate, 30% exposure I have in mutual funds, and about 10% is the LIC policies and PPF.
Okay, now your investment journey began close to 2 decades ago. Your father used to do that earlier. So how does your approach to investment differ from his approach to investment?
Since my dad was a government employee, he started in a very conservative way, and the options he had with him were very few. Today we have a wide basket of mutual funds, and stocks and everything. Since I was interested in long-term investment for my long-term goals, I went quite aggressive. Like I had about 50% exposure in the equity funds. Then balance exposure was in balance funds. I have virtually no exposure in any debt funds or something.
Okay, so your investment journey began in '89. So at that time you invested directly in stocks. Then you graduated on to mutual funds. So tell us about that experience. How did you come across the idea of investing in mutual funds, and how has that experience panned out so far?
Initially, when I started with stocks, there was a time when IPOs were giving you good returns. But after losing money in a couple of IPOs, we decided to shift our portfolio. That was the time when the mutual fund industry was coming up in India. I was very fortunate to meet Ravi, who was able to guide me through the mutual funds, And then we sat down together and we prepared a basket for every member of the family. And since then, we've been following it with a discipline for like 25 years. We are into mutual funds now. Okay,
so let's focus on Rajesh now. How would you characterize his risk profile for investment?
See, when he came to me, he was very young. And as a young couple, they came to me and with a newborn baby. And they as any young parent wanted a very good future for their children, and they wanted to save and realize their dream for not only themselves but for their children as well. And in a small way, they started through SIP into equity funds, and slowly they built their corpus. And today we are very proud that his one son is already studying abroad, and they are dipping into the portfolio that we created for that long.
Okay, and between his fund investments, between equity and debt, what's the sort of percentage?
Oh yeah, in fact, since the age was in their favor, so we went aggressive and we just created an equity portfolio and nothing in debt at that point of time.
Okay, and what are some of the do's and don'ts that you would advise to investors who say don't have that much of a risk appetite? What should they be looking at? What sort of funds should they go for?
See, if you are sitting on a very low risk appetite, then there are debt funds which take care of your regular return, but a low regular return and low risk in that. But if you are young, I must advise to my clients and to everybody who's watching this program that they must participate in equity, because equity over a period of time deliver long-term healthy returns. So just participate in market. If you are absent from the market, capital market, you are taking the biggest risk of your life.
All right. Now, if an investment wanted to say hedge their bets between equity and debt, the usual route would be balance funds. But lately, dynamic asset allocation funds are also being looked at as an option. Now, what sort of investors are these products suited for, and what should they be looking for in say, a dynamic asset allocation
fund? These are recently launched funds. Many of them are not participating in the rise of the market. When the market is rising, they don't actually ape the return of the rising market. They give slightly lower than the return of the Nifty. But the beauty of this product lies when the market falls, they fall far less than the others. Okay. So how do you make money? You make money two ways. Either you rise or you fall less. So here most of these funds fall less when the market goes down. Okay. So this way they give you the return, and in fact if you do the back testing, in the last 5 or 7 years time of back testing, they have been the best performers.
And which type of investors are they suited for? I mean, for an investor looking between a balanced fund and a dynamic asset allocation fund, which profile of investors would choose the latter?
Yeah, certainly people who are looking for balanced fund investment can participate in dynamic, and also slightly above risk than the MIPs, they can participate in this because they keep shifting their equity portfolio. As far as the risk is concerned, they are not really risk-free because they still can go to 100% in equity. So I won't say that they are risk-free or they are low on risk, but definitely they are, as compared to the pure equity funds, they are less risky.
All right, and since we are on the topic of risk, what sort of risk management tips would you share with our viewers who, when it becomes incumbent on them to kind of raise their risk appetite to generate returns, but the broader economic environment in terms of growth is a bit tempered? What would you tell them how to manage risk in that scenario?
Yeah, I mean, today, India, fortunately, we are sitting in such a sweet spot where we are looking at a long-term growth in India in the next 10, 20 years to be humongously great. So what I suggest, even if you have a low risk appetite, must participate in the equity market. At the same time, you can also build your portfolio into debt and these new age products, as we were just mentioning. So the entire risk is by not participating in equity market. You must realize one thing, that India today is $1.3 trillion economy. And going forward in next 10 years, we are hoping that it will be $4 to $5 trillion economy. If it is $4 to $5 trillion economy, our stock market is not going to be here where it is today. It is going to be much higher than this. So participate in this growth, India growth story. And the biggest risk probably will be from the absence of the stock market.
Okay, taking forward, the point Ravi has mentioned, property constitutes around 60% of your portfolio, and considering that returns are not exactly stable in that arena right now, and mutual funds have been doing pretty well. What's your game plan here? Are you looking to kind of downsize some of your property portfolio and shift it to mutual funds and other options?
See, at my age today, I'd like to play safe, and definitely the real estate market is very unstable today. I would prefer exiting on a given opportunity and increase my exposure in mutual funds. Okay. That should be my game plan in next couple of years to do.
Okay. Rajesh, tell us a bit about your short-term goals and how you have calibrated your investments to achieve them.
See, short-term goals today for us are, to look after that our children are able to complete their education, taking care of the health of our elders in the family, and of course, holiday plans. Since the investments were started very long ago, at any point, we do not hesitate whenever we need funds to withdraw from mutual funds. We do not look today at the market whether the market is down or up, because we know that we are in plus, because we started investments 20 years ago.
All right. On that note, we'll take a short break on the Mutual Fund Day Family Financial Plan series. Stay tuned as we focus on the long-term goals of Rajesh and learn how he can smartly fund them with the help of his financial planner, Ravi Kohli. Stay tuned.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
We're back on your screens for the final segment of the Mutual Fund Day Family Financial Plan series, a show that's all about making your money work hard for you. So let's pick up where we left off with our guests. Rajesh, let's talk about your long-term goals, especially the idea of funding your children's entrepreneurial dreams. What are your funding targets for that?
See, I do not have any such specific financial targets for them. We've been following SIPs since they were born. So I'm pretty sure they would be having handsome working capital funds in case they decide to become businessmen. Or They will definitely have the backup of the real estate if and when required. We have not put any specific targets.
Okay. Ravi, to get an expert perspective from the for viewers who are watching this, who have this long-term goal for their children in case they want to start new businesses, which again, it becomes a very flexible target, a very fast-moving target for them to pin down and plan their finances for. What would be your suggestion to them?
My suggestion is like education, a higher education which will come after 18 years of child's age. Even this requirement of setting up a business for a child will come at the age of probably 25, 26 when he has done his post-graduation and all. So there is ample time to create a huge corpus for a child to create that stepping stone on which he can build his business. So I again suggest the same thing. As you have saved for the higher education, you must save in the equity market because the time is with you. And the stock market is actually a very intelligent game because the wealth gets transferred from impatient to patient. So when you have patience for 25 years to wait, the wealth has to be created. There is no second option for wealth not to come to you.
Okay, but that patience also entails making the right choice, which will also involve a lot of thinking on which funds to choose. So when an investor reaches that juncture of choosing a fund for funding his or her long-term plans, what should they be looking at? Because that's not a short-term fund. That's a long-term fund where you need to stay invested. So what should they be looking at?
So we strongly recommend people to have something like about 70-75% in large cap funds and 20-25% in mid-cap fund when you are having a target of 20-25 years in your mind.
And now, insurance and PPF count about 10% of Rajesh's portfolio. Focusing on the latter, what's the best way to kind of get the most out of one's PPF account, considering the low interest rate environment? What suggestions would you give to our investors?
Well, PPF earlier was saved only for the purpose of saving taxes. Today, you have instruments like tax saving schemes from the mutual fund, which are giving you the same option. And so again, these schemes are for long-term schemes. So if you are investing for 15 to 20 years time, so any day it is far better to remain in equity-linked tax saving schemes rather than PPF. Okay. Though PPF have its own advantages, but if you are comparing with the return point of view on a long term, it outsmart PPF.
Okay, and insurance-wise, how are you geared up?
I have two kind of insurance policies. One is the fixed return schemes, like which will be cashable like after 10 years or after 15 years. Then we do have the medical insurances with us and the general LIC policies we have some.
Okay, and before I come to my last question, there is some speculation about merging of mutual fund schemes in the same investment category. How does this impact investors if it actually goes through? What's your view?
Well, this is a need of the hour, and they must merge the similar sounding scheme or where the objective of the scheme are absolutely same. There is no need to start two schemes or three schemes in the same fund family. You have to create a different paraphernalia, like you have to have a fund managers, and basically it's a very costly affair to run similar sounding three different schemes in the same fund house. So it is actually cost effective to merge them, and in fact it creates less confusion in the mind of the investor. And SEBI is very particular about this, that you must come and bring these schemes together. And we are very happy that most of the fund houses are actually volunteering to do it. And I think this is for the benefit of the investor, and people should welcome it. We welcome it.
Okay. So let's conclude the discussion with one last question to you, Rajesh. What are some of the lessons that you have learned in your investment journey that you would like to share with our viewers?
See, lessons learned are like you do not have to exit SIPs. They have to be very, very long term. 5 years, 10 years, you look. And don't look at your portfolio every day.
Okay. And Ravi, your summary statements for our viewers,
I
suggestions?
think what he's saying is actually I ape the same thing, but so there is no way of making a long-term wealth with the shortcuts and all. And be a patient investor and a long-term investor. Market will reward those people who have tons of patience, and happy investing and lots of money to all of our viewers and our clients.
All right, we certainly hope so. With that, it's a wrap for this episode of the Mutual Fund Day Family Financial Plan series. Thank you to our guests for sharing with us their points of view, and thanks to our viewers for tuning in. We'll be back with a brand new journey of financial planning for the next show. Keep watching CNBC TV18.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Focus. Ideate. Innovate. Enable.